Welcome to the Deep Dive, the show that takes mountains of research and, well, distills it right down to what you actually need to know.
And today, we are strapping in.
We really are. We're exploring one of the biggest, most complex parts of the economy. I'm talking about the gargantuan $1.686 trillion real estate sector.
It's a monster.
It is. So our mission today is pretty simple. We're diving into what the market looks like right now, dissecting the main ways to invest, these things called REITs, and most importantly, we're pulling out exactly which trends and which specific stocks analysts are calling the best buys.
It's a shortcut to getting up to speed, really.
Welcome to everything you need to know about finance.
And we should start with a clear advisory. We're here to help you understand what the experts are saying. This is a knowledge deep dive. It is absolutely not financial advice.
Exactly. We're just the guides here, not the gurus. And if you find this kind of content valuable, please take a second right now to like and subscribe. It really helps us keep these deep dives coming.
Okay, so let's set the stage. Real estate long-term has been a pretty reliable place to be. If you look back over the last 5 years, the sector's given a solid return, almost 30%.
So plus 29.55% to be exact. If you were in 5 years ago, you're pretty happy.
You're generally happy, yes, but, and this is the big but, when you look at right now the year-to-date performance, it's a very different story.
Much more moderate.
Much more. We're talking just under 5%. That long-term number shows stability, but the recent number, well, it shows a lot of volatility and some serious headwinds.
Which means it's a stock picker's market.
It's the definition of a stock picker's market. You have to know where to look.
Okay, so let's unpack that. We know real estate is crucial. It's often used as that hedge against inflation. But for most people, buying, a shopping mall or an apartment building, it takes huge amounts of cash.
And expertise. Never mind dealing with tenants.
So how does the everyday investor get a piece of this action without dealing with a leaky faucet at 2 in the morning?
Well, the standard answer is the Real Estate Investment Trust, or REIT.
Right.
Just think of a REIT as a company that owns and operates a whole portfolio of commercial real estate. Offices, hotels, warehouses. And they make their money primarily from rent.
And the big draw, the reason you see them in so many retirement accounts, is that income stream.
Precisely. REITs have a legal requirement. They have to distribute at least 90% of their taxable income back to their shareholders.
So you get these steady, routine dividend payments.
That's the goal. It makes them really attractive for anyone looking for reliable income from, hard assets.
And the research shows a pretty clear ladder of how to get involved, right, in terms of difficulty.
A very clear one. At the bottom, the easiest is buying into REIT ETFs or mutual funds. You get instant diversification, very little hassle.
And then it gets riskier.
Then you move up to real estate investing platforms. Crowdfunding, essentially. This gives you a taste of private market deals, but it's often speculative and very illiquid.
Meaning your money is tied up for a long time.
It can be very hard to get out quickly. And a lot of these platforms are only open to what they call accredited investors.
Which has a high bar, right? Like $200,000 in income or $1 million net worth.
Exactly, excluding your house. So it cuts out a lot of people, though companies like Fundrise and Realty Mogul are trying to open that up a bit.
And then after that, you're basically into direct ownership with all the headaches we talked about.
All the headaches.
Yeah,
so you can really see why the REIT model is so low friction by comparison.
So we've set the table. Now let's look at where the real action is with those year-to-date numbers. The overall sector is kind of flat, but inside it, it's an absolute battlefield of winners and losers.
This is the real aha moment when you dig in. You see this huge split. Traditional categories are struggling while the sectors tied to, fundamental human needs are just soaring.
Okay, so let's talk winners. Who is crushing it?
The strength is frankly astonishing in a couple of places. REITs focused on healthcare facilities are the #1 performers we saw. Year-to-date returns are at an incredible 48.96%.
Wow, almost 50%. That's massive.
It's huge. And right behind them, real estate development companies are up 48.64%. These are sectors riding these powerful, unstoppable demographic waves.
And on the other side of that coin, we know the work-from-home trend is still just hammering office spaces.
Oh, it is. The biggest laggard by far is the REIT office category. It's down over 16% this year.
Yeah.
But here's the paradox.
Go on.
Residential REITs, so apartment buildings, are also struggling. They're down over 9%.
Now that's the interesting question. If housing is so expensive and we hear about rents being sky high, why is that category losing value?
It seems counterintuitive, right? The revenue is there. The problem isn't the rent checks coming in, it's the cost of debt going out.
Ah, so interest rates.
It's all about interest rates. These companies operate on mountains of debt. When borrowing costs shoot up, it just erodes all that rental income. The high cost of capital is pushing their asset values down, even while there's still a housing shortage.
That clarity is so important. So let's use a case study to understand the metrics here. The research highlighted a $3.5 billion Canadian company, Dream Industrial REIT.
Right, and they have strong results. They reported that their FFO per unit was up 4.3% year over year.
Okay, stop there. FFO. You hear that acronym all the time with REITs. What is it and why does it matter more than, say, net income?
Great question. FFO stands for funds from operations. It's the key metric because it adds back depreciation.
Which is a non-cash charge.
Exactly. Real estate depreciation on an accounting statement can make a healthy company look unprofitable. It doesn't reflect the actual cash being generated. FFO gives you a much, much clearer picture of the operational health.
And they also mentioned the strategy of capital recycling, targeting high yields in Europe. They were hitting something called cap rates over 8%. What is a cap rate?
So the cap rate is just the property's net operating income divided by its purchase price. Think of it as the expected return on that piece of property. A higher cap rate is better.
So 8% is good.
8% is very good. So Dream is selling its lower yielding assets, maybe at 5% cap rates, and using that money to buy higher yielding properties in places like Germany, getting 7 or 8%. That's active management that directly boosts shareholder returns.
That brings us perfectly to the analyst recommendations. The research pointed to 8 specific stocks as best buys for 2025, and they're all tied to these huge multi-year trends.
Right. We can basically group these 8 names into 4 big resilient themes.
Let's start with trend 1, e-commerce and logistics, the backbone of, well, everything we buy online.
This is all about Prologis Inc., ticker PLD. And yes, the obvious driver is e-commerce, which is projected to grow from about 16% of retail sales to over 27% by 2030.
But what makes Prologis the top pick in that space?
It's their scale and location. They are the absolute market leader in last-mile logistics, the warehouses you need close to cities to get packages to your door quickly. That's a huge barrier to entry for competitors. Plus, they benefit from the growing need for data centers.
Okay, moving to trend 2, digital infrastructure. The 5G rollout, streaming video, everything on our phones.
Here you've got 2 giants, American Tower Corp, AMT, and SBA Communications, SBAC. They own the physical cell towers that carriers lease space on. They thrive because our hunger for mobile data just keeps growing.
And SBA Communications has incredibly strong financials. The reports mention tower cash flow margins consistently above 85%. How do they keep margins that high?
It's the business model. Once a tower is built, the operating costs are pretty low, but they have these long-term inflation-adjusted contracts with the big carriers. They're less tied to the economy's ups and downs and more tied to our need for bandwidth.
And American Tower, AMT, has a big international angle, right?
A huge one, especially in emerging markets like Africa, where 4G and 5G penetration is still only around 15%. I mean, that's decades of potential growth right there as those populations come online.
Okay, let's shift gears completely. Trend 3, demographics and healthcare. The silver tsunami.
Exactly. Here we have Ventas, ticker VTR, and Alexandria Real Estate Equities, ARE. Ventas owns senior housing and medical office buildings.
A pure play on the aging population.
A total pure play. The number of Americans over 80 is set to grow almost 5% every single year through 2030. That is an inelastic demand wave. We simply don't have enough facilities to meet it.
Now, Alexandria is interesting. They focus on life sciences labs, but they've underperformed recently.
Yeah.
Why do analysts see that as a buying opportunity?
It seems odd, but that underperformance is the opportunity. It's mostly been dragged down by general fears over interest rates, not a problem with their actual business, which is renting mission-critical lab space for drug development.
So the long-term trend is still intact.
Very much so. Analysts see the recent dip as a great entry point. And it's worth noting they have a really high dividend yield right now, over 7%.
Okay, final trend. Trend 4. Housing affordability and services. Basically, profiting from the fact that no one can afford to buy a house.
That's a blunt way to put it, but it's accurate. Here we have 2 big apartment REITs, Avalon Bay Communities, AVB, and Equity Residential, EQR.
They own huge apartment complexes.
Exactly, and despite the headwinds we talked about, their whole business model benefits from single-family homes being just out of reach in major coastal markets, LA, New York, Boston. EQR's average rent is over $3,100 a month.
And Avalon Bay is shifting its strategy a bit.
They are. They're putting over $1 billion into new projects in 2025, but they're focusing more on suburban communities, meeting that post-pandemic demand for more space just outside the city.
And the last name is CoStar Group, CSGP. They don't own property, but they're a key part of the system.
Right. CoStar is the service and data giant. They own the online marketplaces like apartments.com and homes.com. They provide the data and the platform, which gives them this fantastic high-margin business that works in any economic cycle. Homes.com in particular was highlighted as a huge growth engine for them.
So when you put it all together, the real appeal of a modern REIT is what?
It's that you're getting this low-friction exposure to massive, essential long-term trends. E-commerce, 5G data, an aging population. These things aren't going away. And you're getting paid through dividends while you wait.
And looking forward, it feels like the one thing that hangs over every single one of these stocks, from cell towers to apartments, is interest rates.
Absolutely. The analyst consensus is that potential interest rate cuts from the Fed are the major catalyst everyone is waiting for.
Because that would lower their borrowing costs.
It would relieve those intense headwinds, let their earnings multiples expand, and support asset values for the residential players. The macro environment is really the final piece of the puzzle.
And that seems to be the critical takeaway. The real estate sector has clearly split. You have these high-growth, necessity-driven areas like healthcare and logistics, and then you have others facing huge structural problems, like office.
A real bifurcation.
So as an investor, the question you have to ask yourself is, which of these multi-year trends seems the most bulletproof, the most resilient to whatever the economy and the cost of money throws at it next?
A fascinating place to continue your research.
We hope this deep dive gave you the clarity you need to navigate this really complex sector. To continue your learning journey, try out our latest episodes.
Goodbye for now.
See you on the next deep dive.